AI-driven equities are surging even as an energy shock and higher for longer rates reshape the macro backdrop. This is vTalkInsight, Allocator's lens daily for April 27th, 2026. Let us start with equities, where powerful earnings momentum now sits alongside rising geopolitical and inflation risks. In equities, the headline remains an exceptionally strong tape led by technology, hardware, and semiconductors, even as the macro picture gets noisier. The S&P 500 is at record highs after 4 straight weeks of gains in April, with roughly 80% of reporting companies beating earnings expectations and revenues growing about 7%. Risk premiums in both equities and credit have slipped to around 20-year lows, signaling a market that is very confident growth will not meaningfully deteriorate. The most striking story is chips. Semiconductor indices have rallied more than 40% in less than 3 weeks, with an 18-day winning streak driven by relentless AI infrastructure demand. Intel has delivered its biggest revenue beat in 5 years, raised its sales outlook, and seen its share price jump more than 20% in a single session, while other old-guard hardware names are also rebounding strongly. At the same time, breadth is narrow, with only a modest share of S&P constituents advancing, and flows data suggests CTAs and hedge funds are providing much of the marginal demand, even as some semiconductor ETFs see profit taking outflows. Regionally, leadership is concentrated in the United States and North Asia. U.S. and Taiwanese tech, including TSMC, continue to benefit from huge AI-related capital expenditure, supported further by rule changes that allow local funds to concentrate more heavily in single stocks. In contrast, European equities are lagging, with the Euro Stoxx index down this week, and most sectors in the red apart from energy. Europe lacks a deep secular tech growth engine to offset its energy exposure, and earnings growth there is expected to be modest and focused in banks and energy rather than broad-based. Beneath the surface, the equity story is increasingly bound up with the energy shock. Brent trading well above $100, driven by disruptions in the Strait of Hormuz and a huge estimated production shortfall, is squeezing energy-intensive sectors. Airlines face billions of dollars in extra jet fuel costs. Several have cut profit guidance, and while higher fares are being passed through for now, there's a clear risk that persistent price increases could eventually erode travel demand. For the broader consumer, surveys suggest around 80% of U.S. households plan to reduce spending, and real wage gains have collapsed since the Iran conflict, even though retail sales and corporate earnings still look robust. This creates a tension for allocators. On one hand, earnings growth has broadened beyond a handful of megacaps, with a median Russell 3000 company now showing close to 14% profit growth, U.S. corporates holding over $1 trillion in cash, and liquidity indicators such as money and loan growth rising at about a 10% annualized rate. On the other, valuations embed a roughly 90% probability that growth will stay intact despite geopolitical conflict, supply chain strains, and an oil price shock. The key near-term catalyst is the upcoming earnings cluster from the largest tech platforms, which together plan around $650 billion of AI-related capital spending this year. How those numbers land, and how markets treat any single stock disappointments, will be critical in judging whether this AI-led rally can broaden or whether narrow leadership becomes a vulnerability as rates and energy costs bite. That leads directly into the rates backdrop. Rates markets are converging on a higher for longer view as the energy shock feeds back into inflation data. Developed market inflation is expected to move towards or above 4% in coming months, and upcoming personal consumption expenditures numbers are projected to rise from roughly 2.8 to 3.6%. In the United States, core services inflation and tariff-exposed prices are running in the 3 to 4% range, raising concerns that price pressures are not just about oil. Against that backdrop, central banks are signaling a desire to look through the current energy-driven spike and largely keep policy rates on hold. Commentaries suggest the Federal Reserve is unlikely to cut for several meetings, with some economists seeing little or no easing this year, even though parts of the market still envisage a first cut around September, contingent on both softer inflation and some resolution in the Gulf. Yields on major government bonds, from German bunds to Japanese government bonds, are hovering near multi-decade highs, while U.S. two-year yields have moved sharply higher as investors reprice near-term inflation risk. In Europe and the UK, some see value in front-end government bonds, where elevated yields come with optionality should growth roll over and central banks eventually pivot. More than the precise level of yields, many allocators are focused on bond market volatility as the key cross-asset risk. With 3 U.S. aircraft carrier groups deployed in the Middle East and the Strait of Hormuz still not fully secure, any escalation could trigger a spike in rate volatility that matters more for equity valuations and credit spreads than a gradual drift higher in yields. Rising term premia, large fiscal deficits, and heavy capital needs from the AI build-out all point to a challenging environment for long-duration assets, which are already underweight in many portfolios, while shorter-dated bonds are being used as income sources and dry powder. How that balance evolves will shape the next chapter for credit. Corporate credit still looks remarkably calm on the surface. Investment-grade issuance is running at record levels, with new deals oversubscribed by more than 4 times and concessions compressed to just a few basis points. High yield has seen roughly $30 billion of new supply so far this year, which has generally been well absorbed, and both investment-grade and high-yield spreads remain tight by historical standards. Underneath that calm, the AI infrastructure boom is reshaping balance sheets and funding structures. Major technology platforms are locking in long-term debt between about 5.5 and 7% to fund chips, data centers, and grid connections, while more of the underlying assets are financed through project finance and triple net leases with non-recourse features. Some large, highly leveraged transactions, such as multi-hundred-billion-dollar partnerships in AI infrastructure, have proved harder to syndicate, and in high yield, a growing share of index-level issuance now comes from AI and data center names, where a few deals have underperformed. Airlines are another obvious weak spot, as energy costs surge at the same time that many carriers enter this cycle with already stretched balance sheets. Commentary flags stagflation as the main macro risk for corporate credit, although current conditions are still far from the worst historical episodes. Solid earnings, with about 7% revenue growth and stable margins, together with large corporate cash buffers, underpin today's tight spreads. However, with risk premiums in both equity and credit at multi-decade lows, the cushion against a shock is thin. A combination of weaker growth, a renewed spike in bond volatility, or a more persistent inflation surprise that forces central banks to tighten again would be the scenarios to watch for a more material repricing in credit. FX markets are already reflecting some of these cross-currents. Foreign exchange sits at the intersection of the rate and growth narratives. There is growing discussion that beyond the near term, a shift toward a somewhat weaker U.S. dollar could support international equities after years of underperformance, especially if inflation outside the U.S. proves sticky and nominal growth remains reasonable. That is happening alongside a slow trend towards more diversified reserve holdings and greater use of alternative currencies in trade, even as the dollar still benefits from depth and liquidity. The Japanese yen remains under pressure, trading in a tight range near the high 150s against the dollar. Official warnings about potential intervention appear to be deterring outright speculative attacks, but without a decisive move from the central bank, the currency stays weak and sensitive to any surprise in U.S. or Japanese yields. In emerging markets, carry trades remain popular, but they are increasingly exposed to the combination of higher developed market rates, energy-related inflation shocks, and the possibility of risk aversion if geopolitical tensions escalate. Safe haven currencies and assets, such as the Swiss franc and gold, continue to attract interest as hedges against both geopolitical and inflation uncertainty. Oil exporters benefit from the current price level, while large importers face deteriorating terms of trade, which feeds back into currency performance and central bank reaction functions. Importantly, expectations for eventual U.S. rate cuts and for the dollar path are now explicitly linked to outcomes in the Gulf. A durable de-escalation that takes pressure off energy prices would make it easier for the Federal Reserve to ease, whereas a prolonged conflict would tend to keep both the dollar and short-term rates supported. Those same dynamics are most visible in commodities. Commodities, and oil in particular, remain the macro hinge for this whole setup. The Strait of Hormuz is effectively operating under severe strain, with blockades, mine-clearing operations, and a heavy military presence that could take months to normalize. Analysts estimate current global production is more than 14 million barrels per day below pre-war levels, and tankers are being rerouted around the Cape, adding time and cost to deliveries. Since February, Brent prices have climbed about 45%, holding well above $100, while U.S. crude trades just under that level. This shock is feeding directly into inflation and growth expectations. Higher fuel costs are a clear drag on real incomes, with surveys indicating that a large majority of U.S. consumers plan to cut spending and measures of consumer sentiment stuck near record lows. Germany offers a textbook stagflation example, with rising prices and slowing activity driven by energy bottlenecks. European governments are responding with short-term subsidies, discussions of windfall taxes on energy companies, and an acceptance that defense spending will rise despite tight fiscal positions. But policy coordination remains patchy and fiscal burdens uneven. Structurally, global oil flows are being rewired. There has been a surge in very large crude carriers heading towards the United States, even as U.S. production stays flat and rig counts decline, suggesting that much of the adjustment is happening through trade routes and stockpiling rather than new supply. Several perspectives argue that, even if the immediate conflict ends and prices retrace, strategic reserves and inventory rebuilding will keep a higher floor under crude for years. At the same time, selective policy steps, such as shipping waivers for U.S. refiners, show how governments are trying to temper domestic fuel prices without fully undoing the global risk premium. The energy shock is also accelerating the transition story. Rising fuel costs and narrowing price gaps with internal combustion cars are boosting interest in electric vehicles, with European sales up strongly and used EV prices in some regions now comparable to gasoline models. Companies like Siemens Energy report stronger demand from data centers and power grids, while ultra-fast charging and the rollout of charging stations at retail locations underline the CapEx wave into electrification infrastructure. Together with growing interest in defense, shipbuilding, drones, and traditional resource producers, this points to a regime where real assets and energy security are central to macro and market outcomes. Oil and commodity prices therefore remain the key indicators to watch for how inflation, rates, and cross-asset correlations evolve from here. Pulling it together, today's cross-asset picture shows AI-led equities pushing to records, credit spreads near cycle tights, and the dollar still broadly supported, all while an oil shock and sticky inflation keep central banks in a higher-for-longer stance. The main tension is between very low-risk premiums in equities and credit, and a macro environment defined by geopolitical fragility, rewired energy supply chains, and the potential for bond volatility to jump if the Gulf deteriorates further. For allocators, the key signposts are clear: the durability of earnings in AI and energy-exposed sectors, the path of core inflation and wage data, any sudden move in rate volatility, and whether the Strait of Hormuz situation stabilizes or escalates. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.